Each session today adds a new layer to our understanding. As we continue this journey of knowledge, it's time to move forward to our next segment. As aspiring chartered accountants, we are deeply familiar with the frameworks, standards, and rigor involved in corporate financial reporting. However, a significant portion of our economy operates outside the formal corporate sector, comprising non-corporate entities such as sole proprietorships, Hindu undivided families, partnership firms, associations, cooperative societies, and trusts. These entities contribute significantly to employment, income generation, and community development. Yet, their stories are not always captured in the traditional financial or regulatory reports. Let us now delve into the depth and impact of these vital topics. Dear esteemed guests, it is my honor to welcome you all to this knowledge session 2 on the topic non-corporate reporting. It is with great privilege that I introduce our distinguished chairperson for this session, CA Gautham Nayak M, who will be guiding us through the discussions on this topic. We are honored to be joined by a talented panel of paper presenters, each of whom brings extensive knowledge and expertise in their respective domains. They'll be presenting their research and perspectives, adding depth and valuable insight to our understanding of the subject matter. I now call upon CA Daniel Marsh Pereira to escort our esteemed chairperson of the session to the dais, along with the paper presenters. With great respect, I request CA Daniel Marsh Pereira to present a token of welcome to our dear chairperson and paper presenters. We welcome you with this sapling, a token of growth, wisdom, and renewal. May the knowledge you share today take roots and flourish in many hearts. Thank you, sir. As we commence the session, it is my privilege to introduce our distinguished session chairperson, CA Gautham Nayak M. A practicing chartered accountant of Mangaluru, sir has been actively engaged in the profession since 2013. His academic and professional journey reflects deep commitment and diligence, having qualified as a chartered accountant in 2012, followed by the prestigious DISA qualification in 2014 and certification in concurrent audit of banks in 2015, both awarded by ICAI. He continues the legacy of excellence set by his father, CAM Rayappa Nayak, a seasoned chartered accountant with over 3 decades of experience who has been a guiding force in his career. His expertise spans across audit and taxation matters, encompassing both direct and indirect taxes, making him a sought-after consultant in his domain. Outside of his professional practice, Sir is a passionate teacher. He has taught taxation to CA students at the Mangaluru branch of ICAI and also contributed to undergraduate education through his association with Premakakti Educational and Charitable Trust. His knowledge sharing extends to several professional forums where he's been invited as a resource person. He is currently serving as the chairman of the Accounts and Audit Committee of KCCI and has played a pivotal role as a part of the managing committee of the Mangaluru branch, including serving as its chairman for the year 2023 to 2024. Under his chairmanship, the branch was awarded the second best branch of the Southern region and second best Student Association Award at the national level for the year 2023. He is also a member of the State Economic Cell of a national level political party. On the other hand, Sir is a treasurer at Swaranand Pratishthan, an NGO promoting Indian classical music in Mangaluru. Your presence here is a source of pride and inspiration to all of us. On behalf of Mangaluru branch of Sikasa of ICI, I extend a warm and heartfelt welcome to you, sir. I am honored to introduce our competent paper presenters who will be guiding us through a series of insightful and enlightening discussions. Our first paper presenter is Ms. Chaitanya, who will be presenting the paper on how is financial reporting different for non-corporate entities compared to companies under Indian GAAP. Ms. Chaitanya is a final year student currently undergoing articleship with Messrs. Ballakuraya and Associates. Demonstrating great dedication and enthusiasm, she has also presented a paper on transfer pricing under Income Tax Act at National Level Conference 2024 held in Mangaluru. Beyond academics and professional pursuits, she enjoys drawing, reading books, and spending quality time with her pets. Please join me in extending a warm welcome to Chaitanya. Without further ado, let us begin with the first topic of the session. Over to you, Chaitanya.
Financial reporting is not just about numbers. It's about transparency, accountability, and trust. Principles that must be balanced differently for the non-corporate entities and for the companies to reflect the unique role in the economy. A very good afternoon, respected dignitaries, organizers, and all the esteemed audience present here. I am Chaitanya, CA final student, pursuing my articleship from Messrs. Ballakuraya and Associate. I am here to present on the topic, how is financial reporting different for non-corporate entities compared to companies under Indian GAAP. These are the topics which we'll be covering under this. To begin with, let us first understand what exactly is non-corporate entity. Non-corporate entity is a business or organization structure that are not registered as corporation under any statute, such as Companies Act or any other regulation. These are generally owned and managed by individual or group of individuals without separate legal entity status of a corporation. Example includes sole proprietorship, partnership firm, HUF, trust, cooperative society, etc. Although some of the entities such as cooperative society and LLP have a separate legal entity, but they are still considered as non-corporate for the purpose of financial reporting under Indian GAAP. Non-corporate entities have simplified legal structure and are governed by the different law depending on the forms. For example, partnership firms are governed by the Partnership Act 1932. The Institute of Chartered Accountants of India is a primary authority to issue the accounting standard and the guidelines for the non-corporate entities. The recent guidelines notes has been issued for the financial year 24-25 to provide the standardized framework for the preparation and presentation of financial statement. Before that, there was no standard format for the preparation of financial statement for the non-corporate entities. Whereas companies are formed and registered under Companies Act 2013. They have separate legal identity from their owners and are governed by the strict regulation. Companies are required to prepare their financial statement as per Schedule 3 of the Companies Act. They are typically owned by shareholders and governed by the manager. The term financial reporting refers to the process of documenting, presenting, and communicating organization financial activity to the stakeholder over a specific period of time. And this is to be carried out in a standardized framework to ensure that the financial are comparability as well as help in the informed decision making. The term Indian GAAP, that is generally accepted accounting principle, refers to the set of guidelines or the standard that are used in India while preparing and presenting the financial statement. Indian GAAP is a broad concept and it includes statutory requirement of Companies Act 2013, guidance note issued by ICAI, relevant provision of Income Tax Act 1961, regulatory guidelines, accounting standard, and Indian accounting standard. Indian GAAP serves as the foundation for the accounting and financial reporting in India, ensuring that financial reporting are done fairly and in accordance with the law. So these are all the basic concepts which you already know. Now let us dive into the main topic. To be honest, it is very complex. So let me take help from my favorite articleship buddy. Hey ChatGPT, what are the differences in the financial reporting between corporate and non-corporate entities? The applicability of Indian GAAP differs for the non-corporate entities compared to companies, and the difference arises due to several reasons, and one of the primary reasons includes regulatory authority. Companies are governed by the Companies Act 2013, which mandates the usage of accounting standard and the guidance as prescribed by the Ministry of Corporate Affairs. Whereas non-corporate entities are governed by the ICAI, they have to follow the guidelines or accounting standard issued by ICAI. And the applicability of accounting standard depends upon the type and size of entities. Companies are classified into listing process or net worth basis. There are two types, like listed companies and unlisted companies. Unlisted companies are further classified into SMC and non-SMC. SMC, that are small and medium-sized companies, which satisfy certain condition or the turnover limit, whereas non-SMCs which do not satisfy the conditions. So listed company or the large unlisted company must comply with all the accounting standard, whereas non-SMCs are required to comply with Indian accounting standard, but they are given certain relaxation, whereas small and medium-sized companies are required to comply with simplified accounting standard, and then also they can also claim exemption in the disclosure requirement. Once Ind AS become applicable to the company, it is also mandatory for its holding, subsidiary and the joint venture to follow regardless of their net worth. Non-corporate entities are classified into 4 levels. Level 1, whose turnover is exceeding 250 crores and borrowing exceeding 50 crore, must comply with all the accounting standard. Level 2, 3, 4, that are micro, medium and small enterprise, whose turnover are below 250 crores and borrowing are below 50 crores, are required to comply with some of the accounting standard. They are also given the exemption or the relaxation. Financial statement requirement. Companies are required to prepare complete set of financial statement, including balance sheet, statement of changes in equity, cash flow statement. Strict format are prescribed as per Schedule 3 of the Companies Act. The format can be downloaded from the MCA website or any other professional resources. Whereas for non-corporate entities, if there is no statutory format prescribed under their own governing law, then they have to follow the format recommended by the ICAI. ICAI has recommended the format through its guidance note, which will be effective for the financial year 24-25. The guidance note can be downloaded from the ICAI official website, Resources Accounting Standard section, where we can get guidance note as well as the Excel template to prepare the financial statement. The objective of the ICAI new format is to ensure standardization of the financial statement to enable comparability and transparency. ICAI format is flexible. It means that you can add, amend or remove certain line of items. Although the guidance note is recommended in nature, but it is mandatory for the chartered accountant to follow. And if the entity do not follow the guidance note, then CA has to issue the qualified opinion in their audit report. As we all know that companies are required to file Form 3CA and 3CD. Apart from income tax requirement, they are also required to file MGT7 AOC4 with MCA as per Companies Act 2013. Whereas non-corporate entities are required to file Form 3CB and 3CD. Auditor is required to form an opinion whether the financial statement are complying with the regulatory requirement as per SS 700. The new ICAI format for the non-corporate entities are modeled closely on the Schedule 3 as prescribed by the Companies Act. Both the format are required vertical presentation of the balance sheet with clear segregation of asset and liability into current and non-current categories. While the ICAI guidance note has incorporated most important element from the Schedule 3 balance sheet, but they have intentionally excluded some of the complex or regulatory disclosure. Now let us understand what are the similarities or what are the common element in the company's balance sheet and non-corporate entities new ICAI format. Rounding of figures. So both the format required to round off their figures for consistency, although it is optional for non-corporate entity. Uniform unit of measurement, that is lakh or crore, should be followed consistently in the balance sheet. Comparative figure. If there is a previous year figure, it should be disclosed for all the elements as well as to the notes to account. Reserves and surplus classification, even if it is negative, they have to disclose under owner's fund and liability. Current liability treatment of payment. If any of the long-term liabilities which are payable within a year, it should be disclosed separately. It should be disclosed as current liability. Disclosure of borrowing along with secured or unsecured and interest rate. Detailed trade receivable disclosure along with the security details. Disclosure of MSME trade payable as per Micro, Small and Medium Enterprise Act 2006. Disclosure of material item. Any item of income or expenses which are more than 1% of revenue from operation or 1 lakh, whichever is greater, should be disclosed separately in the financial statement. Differences are what are not included in the non-corporate entity. Commitment, if there is any ongoing project or the future obligation, pending contract is not required to be disclosed by non-corporate entity. End use of borrowing, if there is loan amount, how and where the loan amount has been utilized, it is not required to be disclosed by the non-corporate entity. Auditor remuneration, additional regulatory information such as financial ratios are not required to be disclosed by the non-corporate entities. Disclosure requirement. So companies have an extensive disclosure requirement, including cash flow statement, related party disclosure, etc. However, small and medium-sized companies are exempted from the disclosure requirement. Then it is not mandatory for them to prepare the cash flow statement as well as the related party disclosure. Disclosure requirement for non-corporate entities. Non-corporate entities have a generally fewer or the simpler disclosure requirement, focusing primarily on the basic financial information. Level or category disclosure. No such classifications are required for the companies. However, if the small and medium-sized company have been claiming any exemption, then such disclosure is required as per Accounting Standard Rule 2021. For non-corporate entities, level and category disclosure is required for the medium, small and micro, small and medium enterprises must state which exemption they have been claimed in the notes to account. Documentation and penalties. Companies are required to maintain proper documentation as well as mandatory disclosure requirement. Non-compliance might lead to the penalties. Whereas non-corporate entities are also required to maintain proper documentation. Auditor must verify compliance with guidance note and applicable accounting standard. Failure to comply with the standard or the format might lead to the qualified opinion which impact the credibility and acceptance of financial statement. At the end, I'd like to conclude by saying that financial reporting for the company is like a strict teacher, demanding comprehensive requirement, whereas for the non-corporate entities, it's like a supportive teacher who provide the structure but with greater flexibilities. And hence, financial reporting for non-corporate entities are more complex and less regulated, whereas for the companies, it has stricter compliance and transparency requirement. This is all about the differences in financial reporting between company and non-corporate entities. Thank you each and every one of you for your patience listening. I will also like to thank Sikasa for providing me this opportunity. Special thanks to my seniors as well as respected sir, ma'am, who helped in my preparation and guided me. Thank you one and all.
Thank you, Chaitanya, for delivering such a well-articulated and informative talk. Let's now move our focus to the next presenter. It gives me great pleasure to introduce our second presenter, Ms. Shreya Bhandary, who will be sharing her expertise on the extent to which accounting standards are applicable to non-corporate entities as per ICAI guidelines. Ms. Shreya hails from Moodbidri and is currently advancing a professional journey by pursuing articleship at Chandrasekhar Kote & Co, Mangaluru. Please give a warm round of applause to Shreya. Shreya, the floor is now yours.
Hello.
Accounting is the language of business. A very good afternoon, ladies and gentlemen. I am Shreya Bhandary, a CA final student. The quote I just shared by Warren Buffett is fundamental truth that accounting is not just about numbers, it's about communication, clarity, and consistency. And just like every language has its own rules, so does accounting. These rules are the accounting standards. Accounting standards are the set of principles that entities use while preparing their financial statements, providing a standardized way of how the financial performance and financial position is. While much of the focus lies on the corporate entities, it's essential to remember that non-corporate entities such as partnerships, sole proprietorships, and trust societies form a backbone of Indian economy. Respected dignitaries and my fellow attendees, I am here before you to present on the topic to what extent are accounting standards applicable to non-corporate entities as per ICAI guidelines. So now, the question is, why did ICAI issue a separate guidelines for non-corporate entities? Well, unlike companies, non-corporate entities are not governed by the Companies Act 2013, which is why the Institute of Chartered Accountants of India issued a framework specifying which accounting standards are mandatory for non-corporate entities based on their size or nature. So, for the next few minutes, we'll be covering evolution of accounting standards for non-corporate entities, applicability of accounting standards, classification of non-corporate entities as per ICAI guidelines, additional requirements, extent of applicability, and also we will explore some of the case studies and examples. So, let's be clear about one fundamental thing right at the start. Accounting standards would apply to every entity which is engaged in commercial, business, industrial activities. So even if very small portion of the accounting standard, like a very small portion of the activities of an entity is considered to be industrial, business or commercial in nature, accounting standards would apply to all those entities, including those which are not commercial, business or industrial in nature. So if we refer the ICAI guidance note, there are three sets of accounting standards at present. First one being very famous, which is ruling our FR syllabus, Indian Accounting Standards, which for specified classes of companies. Accounting standards, as per accounting standards notified under the Companies Accounting Standards Rules 2021, for companies which are not following the Ind AS. And the third one being our topic, accounting standards as per ICAI guidelines. So, if I have to talk about the evolution of accounting standards, initially there was a uniform applicability of accounting standards. This posed certain challenges, especially for micro and small entities, which is why ICAI brought a differentiated framework. Now let's talk about the classification of non-corporate entities. Prior to the revised criteria, there was a 4 level of accounting standard, like non-corporate entities, but at its 433rd meeting, the council revised the criteria and made, now there are 2 types of non-corporate entities for the purpose of accounting standards applicability. First one, large entity. The second one is the MSME entity. Now let's look on to large entity. What is a large entity? A large entity is defined as a non-corporate entity which does not meet the criteria for MSMEs. So in order to know what exactly is a large entity, we need to make sure that what is an MSME is. In order to be qualified as an MSME, it needs to satisfy all these conditions. First one, MSME is a non-corporate entity which does not have its equity shares or equity shares, debt securities listed nor in the process of listing on any stock exchange in India or outside India. Has a turnover excluding other income not exceeding 250 crores immediately preceding accounting year. If we are talking about not about the current year, we need to check the turnover of preceding accounting year. Okay? Then the borrowings should be less than or equal to 50 crore at any time during the preceding accounting year. Then it's not a bank, financial institution, not an insurance company. And also, it is not an subsidiary or holding company of an entity which is not an MSME. Okay, let's move on to a case study here. So there is an entity, XYZ company. You need to tell me whether this is an MSME or not. It's a non-corporate entity, not listed nor in the process of listing. Turnover for the financial year 23-24 is 180 crores, 50 crores borrowing. It's no holding or subsidiary relationship with the non-MSME entity. Whether it's an MSME for the financial year 24-25, it's an MSME. Okay. The next one, Samriddhi Education Trust, non-corporate entity, whose turnover is 80 crore within the limit, 10 crores within the limit. Listing status is not yet listed, but in the process of listing in the zero instruments on the social stock exchange. Whether it is an MSME, it is not an MSME because this listing has happened in the, it is in the process of listing on a social stock exchange. Okay. Now the question is, to what extent are accounting standards applicable to non-corporate entities? Accounting standards apply to all non-corporate entities, but the degree of its compliance is based on its classification. Quick question, how many accounting standards do we have? Yes, we have 27 accounting standards. So large entities are required to comply fully with all the accounting standards, all 27 accounting standards. But MSME have been provided certain relaxations and also exemptions with regard to certain accounting standards. That we'll understand with the applicability matrix. So as I told you, large entities are required to comply fully with all the 27 accounting standards. But now let's focus on MSME part. AS1-2 is applicable. AS3 cash flow statement is not applicable to the non-corporate entities, or the MSMEs. And 4, 5, 7, 9, it is applicable. In case of 10, this is applicable in their entirety, but the thing is, they have been granted certain exemptions in disclosure requirements. If I need to be specific, it is I think 87 paragraph. They are not required to comply with it. Then AS11 also same, disclosure exemption. AS12 is applicable in entirety. 13, disclosure exemption. And 14, it is not applicable to MSMEs. And AS15, along with the disclosure exemptions, they have given also certain other exemptions for, say like recognition criteria, all that. In case of AS16, borrowing cost, it is applicable. Segment reporting is not applicable for an MSME. If I need to talk about AS18, I'll talk about AS18 as well as AS28, impairment of assets. Here, they have been, these standards are exempt for an MSME, but they need to satisfy with two conditions. That is, one, the turnover in the immediately preceding year should be less than or equal to 50 crores. And one more thing is, the borrowing should be less than or equal to 10 crores. In the immediately preceding year. Then other AS20, it's not applicable, 21 not applicable, 23, 24, 25 not applicable, 27 is not applicable, and same, 29 with the disclosure exemptions have been given. Okay. There are certain additional requirements that needs to be kept in mind. Pay attention to this because next two slides are based on this additional requirements for a non-corporate entity. An MSME who is availing an exemption, it must clearly state in its notes to financial statements regarding what it has applied the exemption for, clearly regarding its MSME status as well as on what accounting standards it has applied the exemptions for and what accounting standards it has complied with. One more important point, if an MSME no longer qualifies to be called as an MSME, for example, firstly, it will be an MSME. Then it becomes a large entity. What happens? In this case, it has to comply with all the accounting standard in the current year itself. If you look into the opposite situation, where if a company becomes an MSME, which was previously not an MSME, but becomes an MSME, it has to remain MSME for 2 consecutive years to claim all these relaxations as well as the exemptions. So it has to remain an MSME for 2 years straight. Only then it can avail these benefits. Then, apart from that, if an MSME, it can avail a partial exemption, but it needs to make sure that these exemptions or partial exemption do not mislead or it do not mislead the people reading it. A quick case study. So tell me, in the year 24-25, can it claim AS relaxations or the AS exemptions? Can it claim exemptions? In the year 24-25, it is an MSME because in the year 23-24, its turnover was 240 crores and borrowings were 45 crores. In that case, it became an MSME, but it cannot claim exemptions. Why? Because it has to remain an MSME for 2 years straight. Then only it can apply the benefits. So, one more. Can it claim AS relaxations here? In the year 24-25, it was an MSME. 23-24 also it was an MSME. So here 2 years straight. So you can claim exemption for financial year 24-25. I'm not able to. Okay, with this I want to conclude that every entity has to apply at least minimum requirements of the accounting standards in their entirety. No entity is completely exempt from accounting standards. Then, so this initiative, the applicability and also the classification approach by the ICAI, framework by the ICAI, is a pragmatic approach. So it's important as we, an accounting fraternity, to promote all these guidelines so that more and more non-corporate entity joins the formal economy, building a sustainable business environment and with a strong financial foundation. Thank you very much.
Thank you, Shreya, for such a compelling presentation and the knowledge you have imparted upon us. Moving on to our next presenter, we have Ms. Rachel Janice Pinto, who will be sharing her valuable perspectives on disclosure requirements for trusts and societies under Indian accounting framework. Ms. Pinto is currently pursuing her articleship at D'Souza Lobo Saldana & Co. Chartered Accountants in Mangaluru. A distinguished alumnus of St. Aloysius College, Rachel was the gold medal BCom graduation, exemplifying academic excellence. She has actively contributed as a member of the Mangaluru Sikasa committee and played an integral role as a part of the core committee for the Vikvekam CA Students National Conference 2023 organized by the Mangaluru branch. During her tenure with Sikasa, her team earned national recognition by securing the second Best Students Association Award at the national level. Let us extend a heartfelt welcome to Rachel. Rachel, it's your turn to take it from here.
A very good afternoon to the session moderator, CA Gautham, Nayak, my fellow paper presenters, and the lovely audience. Ladies and gentlemen, picture this. In an Indian town, a trust named Seva Jyoti Foundation collects cash, food, and books. Volunteers even given all their time, because everyone believes that every rupee reaches the right purpose. Then a reporter walks in and drops a bomb by asking, "Can you show us a detailed breakdown of the funds used?" Suddenly, dusty receipts and half-done reports speak louder than words. And that, dear friends, is the real test. Not how noble the mission is, but how well it has been accounted for. I'm Rachel Janice Pinto, and today I'm honored to present on the topic, what are the disclosure requirements for trusts and societies under the Indian accounting framework, which forms the backbone of India's not-for-profit ecosystem comprising of trusts, societies, and Section 8 companies. India is home to over 3 million NGOs powering change in health, education, heritage, and equity. Under the Indian accounting framework, these trusts operate at the intersection of 4 regulatory axes. First, we have the ICAI's technical guide on accounting for NPOs, which raises the bar by enhancing transparency in financial reporting. Second, we have the Income Tax Act, which provides tax exemptions only if detailed disclosures under Section 11, 12A, and 80G are met. For foreign contributions, FCRA compliance is non-negotiable. And finally, we have other regulators like several state-specific societies and trusts act. Let us first look at the disclosure requirements under the first regulator, which is the ICAI's technical guide applicable to charitable institutions. Under this guide, every trust or society, regardless of its size, must prepare financial statements, including an income and expenditure account, receipts and payments account, balance sheet, detailed disclosure of the accounting policies adopted, and get them audited. Now, in case of those charitable institutions which do not engage in any commercial activities, for them, following accounting standards is just optional and recommended, not mandatory. And that is where the technical guide comes into picture. It enhances several key disclosures for all NPOs. Let us now dive into the disclosure requirements under the technical guide. First, we have the balance sheet and fund-based disclosures. Every fund, that is restricted, unrestricted, or corpus fund, must be disclosed separately, including its opening balances, movement during the year, and closing balances. Restricted funds are divided based on time or purpose. And in case of corpus funds, they must be disclosed for the criteria. In case of foreign contributions, the disclosures must be in accordance with the FCRA regulations. Moving on to the investments. Now, when it comes to disclosure requirements for investments, the nature of the investments, that is, whether it's a fixed deposit or a government security or a mutual fund, shares, etc., must be specifically disclosed. And also the valuation methodology, that is, whether it is valued at cost or fair market value, must also be disclosed. In case of fixed assets, disclosure regarding the asset acquisition, that is, whether it is acquired using local funds, foreign contributions, or government grant, must also be disclosed. Moving on to the next statement, which is the income and expenditure account. Now, in this, detailed disclosure of the revenue recognition, depreciation method adopted, employee benefit expenses, asset impairment, and even government grant accounting must be made. In case of deferred income, such as unutilized income or certain restricted funds, a separate disclosure regarding the criteria and time of recognition must also be made. Moving on to the receipts and payments account, which is a cash basis statement. Now in this, we have the opening and closing balances of cash and bank account, along with the total inflows and outflows during a year. So this creates an accurate image of the liquidity of an entity during the year. Finally, we have notes and schedules. Now, as per the technical guide, every trust or society must have a separate fund-based schedule wherein there is a clear picture of the activity happening in each fund during a year. Next, we have the related party disclosures. Now, in this, the nature of the transaction, the name of the related party, the amount involved, and the outstanding balances must also be specifically disclosed. When it comes to contingent liabilities like pending legal cases or capital contracts, this too must be specifically disclosed. All in all, the accounting policy disclosures must be comprehensive, comprising of all the methods that an entity has used. Let us next move on to the disclosure requirement under the next regulator, which is the Income Tax Act, which is crucial for retaining the tax exemption. Every trust must utilize at least 85% of its total income for charitable or religious purposes. And this must be backed by proper books, vouchers, and bank trails. Any unutilized income must undergo formal accumulation process. Now, in order to accumulate this income, trusts must pass a board resolution. They must invest them in specified modes under Section 11, subsection 5, and file Form 10 electronically. This must be filed in the income tax portal at least 2 months prior to the return filing due date. From financial year 21-22, we now have Form 10BD and 10BE, which is a donor-wise disclosure. Now, this must be filed by the trust within 31st May following the financial year so that the donors can claim ATG benefits. Next, we have the detailed 5-schedule audit report under Form 10B. Now, this is applicable to trusts or societies whose gross income exceeds 5 crores or have foreign contribution, or accumulated income. And this Form 10B must be CA certified and filed at least 1 month before the return filing due date. All the figures mentioned in Form 10B must align with the audited financials. Finally, we have the income tax return under ITR 7, which is applicable to every trust or society that is claiming exemption under Section 11, 12A, or 10, subsection 23C. Now, missing these deadlines may result in the trusts losing their tax exemptions and even have penal consequences. We now move on to the disclosure requirements under the next regulator, which is FCRA. What is the key disclosure here? It is the annual return of FC4, which must be filed within 31st December following the financial year. This too must be CA certified, and mainly, it must be aligned line by line with the audited financials. Even a minor mismatch causes scrutiny. Some of the red flags in FCRA compliance are exceeding administration expenses more than 20% before MHA approval, or failure to disclose some of the FD balances or interest income in FC4, and mainly mismatch in figures reported in FC4 with the audit report in Form 10B and audited financials. As a result, since 2020, 6,000 NGOs have lost their FC registration, not due to misuse in funds, but due to disclosure failures. One of the best examples of disclosures done right is the Akshaya Patra Foundation. Their audit report and annual report goes beyond statutory compliance. It includes a detailed financial summary of the accounting policies adopted, related party disclosures, foreign contributions and utilization disclosures, impact-focused disclosures, and various fund-based expenditure-wise disclosures. This culture of accountability and impact-focused reporting has resulted in them being able to serve over 2.2 million children on a daily basis. Despite having clear guidelines, various trusts face several key roadblocks, such as lack of awareness among trustees, limited professional expertise, resource constraints, and fragmented regulatory framework. In order to overcome this, we must harmonize regulations, embrace technology, strengthen financial oversight, and promote impact-focused disclosures. To conclude, disclosures are not a burden. They are the trust behind the trust. The ICAS technical guide and laws like Income Tax Act and FCRA are all building blocks to a responsible ecosystem. As future chartered accountants, our role is not just to verify books. It is to ensure and protect public interest, enhance governance, and ensure ethical practice in the social sector, for which disclosures play a crucial role. Thank you.
Thank you, Rachel, for sharing your valuable insights and inspiring us with your expertise. Finally, and by no means the least, we have Ms. Swathi S Shetty, who will be outlining her findings on her paper on consolidation and group reporting when non-corporate entity holds a significant investment in another entity. Ms. Swathi Shetty is from Mangaluru. She is a CA finalist currently pursuing her articleship at Nitin J. Shetty & Co. Mangaluru. Let's put our hands together for Swathi. Swathi, I request you to take over.
Respected moderator, CA Gautham Nayak, sir. My fellow co-presenters, distinguished delegates and dignitaries, good afternoon to all of you. I am Swathi, and it's a privilege to stand before all of you and present a topic that often goes unnoticed but holds significant implications for financial transparency in India. The topic of my presentation is Bridging the Gap, the need for consolidated reporting by non-corporate entities holding significant investment in other entities. Let's go through the journey of financial reporting and understand why it needs our attention now more than ever. Financial reporting tells us the story of business in numbers. It can be called as the mark card of an entity because it tells how an entity is functioning, what it owns, what it owes, and how does it manage its money. What are the key components of financial reporting? It's financial statements comprising of balance sheet, income statement, cash flow statement, statement of changes in equity if applicable, notes to accounts, including the main character audit report. It's an independent opinion on whether the financial reports give us a true or fair view or not. That is where I can call financial reporting as the cornerstone of transparency and accountability for any business. Let's move on by understanding what consolidated financial statements are. Consolidated financial statements are like a family photo, bringing together the parent's financials and its subsidiaries into one single view. We eliminate intercompany transactions such that financial figures aren't inflated. This ensures that the such statements are accurate, transparent, and are giving us a group level reports such that we can understand how an entire economic unit is performing. Now, you might wonder why we need to go through this trouble of consolidating. Because consolidation gives us the true view. Now, we always say consolidation needs to be done when there is significant investment. Now, when does one entity's influence or investment over another can be called as significant? When an entity holds 20% or more of voting power in another entity, it can mean significant influence. But it's not just about numbers. Having board representation and decision-making power can also mean significant influence. Now, how does consolidation help us? Consolidation gives us a comprehensive picture of how an entire unit is performing. It avoids duplication of transactions, enables that better decisions are taken, increases transparency, builds investor confidence because investors are now able to evaluate risk and strength of the group as a whole. This is why, without them, we are just looking at the fragments and not the full story. But there is a twist in the story. As already discussed by our previous speakers, we are aware that corporate entities must fully comply with all the accounting standards, whereas non-corporate entities do not. Non-corporate entities like trust, partnerships, proprietorships, and societies are classified from level 1 to level 4. Level 1 entities must fully comply with all the accounting standards, whereas level 2, 3, and 4 have got partial or relaxed compliance. That is where they don't prepare consolidated statements. Now, let us understand what are those non-corporate entities existing in India which has significant investment over other entities. Well-known example of Tata Trust, it holds about 66% in Tata Sons, which is a substantial stake. And there is Azim Premji Trust, a philanthropic trust, which holds major holding in Wipro. Despite these significant holdings, non-corporate entities are not mandated to prepare consolidated statements unless they come under level 1. This is where information gap comes in. This is where our framework falls short. Say an entity, which is an NCE, holds 100% of a company, but still it is not mandated to prepare consolidated statements. It can have significant economic influence over other entity, but it's not obligated to prepare or show its group performance to all of us. Thirdly, there can be regulatory arbitrage. What is regulatory arbitrage? Business owners, proprietors, they can misuse the regulatory loopholes that is existing with the use of non-corporate entities. All these leads to what? Reduced financial transparency. Now, let us have a closer view on where things can go wrong. Say, there is a private family trust, which comes under level 2 entities, and it is holding 100% of XYZ Private Limited. XYZ performance goes like this. It has 100 crores of assets, 10 crore in profit. But trust book is showing you only that 10 lakh investment that it had initially made. But the outside world is not aware of the 100 crore business that trust owns. This is why I can say stakeholders are in blind spot. And unfortunately, this is not just theoretical. There have been lot of real-world cases where these type of structures have been misused. Firstly, the Sarada Group scam that happened in 2013. It is a group of 200 entities, but they used mainly non-corporate entities to layer the transactions and hide the flow of funds. Second, we have the Sahara Group scam. What did they do? They used societies and trust for opaque fundraising. In both these cases, due to lack of group level reporting, they could misuse and make such huge scams, huge frauds. This is where I tell, if there is a control in another entity and if it is not disclosed properly, abuse becomes easy. That is why there is a need for reform, because we can see that there has been lot of systematic risk, because there is unreported group structures, hidden liabilities, stakeholders are kept in dark because they are not aware of the crucial financial data of the entity that they are investing into. Thirdly, economic reality discrepancy. What is this now? There is mismatch in who is controlling the business and what is actually disclosed in the financial statements. At the last, we need to re-evaluate transparency. Why? To protect the interest of various stakeholders, we need to make sure that group level transparency at least is mandated. There comes a question, how can all these be handled? How can we bridge the gap between economic reality and financial disclosure? Here is a solution. There can be regulatory intervention. Regulators can issue group disclosure format for non-corporate entities that have significant influence over other entities. Secondly, though full disclosure isn't feasible, key financial indicators can be disclosed, like your turnovers, major liabilities, or profit. Thirdly, we can encourage non-corporate entities to voluntarily adopt AS21. Ind AS is not applicable. AS21, we can encourage them to voluntarily adopt such that there is more transparency in reporting. And lastly, it's our duty to encourage better governance such that we bridge the gap between economic reality and financial disclosure. To sum up, when an entity holds control in any other entity, it needs to reflect them in their financial statements. Otherwise, we are risking by developing a financial system in India that looks stable from the surface, but it is hollow underneath. Thank you for your patient listening. I welcome any questions or thoughts you may have.
Hello, I guess it's my turn to speak now, right, MC? Okay. First of all, I would like to thank the SICASA committee and the managing committee for giving this opportunity to me, because financial reporting for non-corporate entities in a tier 2 city like Mangalore is very, very important. So we started the presentation with Chaitanya, who told us what is a company and what is a non-corporate entity. So in the context of financial reporting for these two types of entities, it's very important for us to know what it is, right? So she beautifully explained us what is a company, what is a non-corporate, proprietorships, partnerships. These are the entities that many small and medium practitioners audit these days. Next, we went with Shreya's presentation, who told us about the various categories that are there in the non-corporate entities. Back in 2021, the ICAI had categorized these NCEs into level 1, level 2, level 3, level 4 by giving various exemptions from compliance with the accounting standards. However, last year, 2024, November, they came out with an announcement, and that announcement is, very similar to the company's accounting standard rules of 2021, where we have this small and medium companies, and similarly we have this MSME non-corporate entities in the announcement. So even the criteria of 250 and 50 is same over there, and whatever exemptions were given to small and medium companies have been now given to MSMEs, that is level 2, level 3 and level 4. Next we had Rachel's presentation. So Rachel's presentation was on financial reporting for NPOs, not for profit organization. The entity structure can be anything. If it is a Section 8 company, then yes, obviously the Schedule 3 would apply. So if it is a society registered under maybe Karnataka Societies Act, or if it is a trust which is registered under the respective state's registration act, then yes, the guidance note would apply, provided they have some commercial transactions. So even a small commercial transaction, if a non-profit organization does, they will have to comply with all the accounting standards depending upon what category they fall in. So beautifully she explained about the listing also in the stock exchange. Sorry, it was your presentation, right? About categorizing social security. Anyways, coming to Swathi's presentation, it was a little, a difficult topic to deliberate upon, because normally we don't see consolidations happening in non-corporate entities. It is very common when it comes to companies. At least in Mangalore, I don't see any private trust holding in companies. There are such entity setups, structures happening in bigger cities. Anyways, she told us why consolidation is very important. So she beautifully gave us the example of Sharda scam, wherein 200 entities were created to hoodwink the authorities, and they were very successful. So why it happened is there was no regulator. There was no regulator, giving them directions that you have to make a proper disclosure. Now coming back to this topic of guidance note for non-corporate entities, the guidance note is binding on whom? The ICAI members, right? So every member, now we are a chartered accountant. Now you are students. But in your respective offices, you are the one who prepare the financial statements, right? The financial statements are actually supposed to be prepared by the management. But in a tier 2 city like Mangalore, when we come to small and medium practitioners, we can't expect some trader in Bandar to, give all these MSME disclosures or tell what is secured, what is unsecured. They'll just get the books of accounts and give. And we then prepare the financial statements. Now, when your boss is going to certify, giving a 3CB report, for example. So 3CB is what? It is a audit report. So Chaitanya, in your presentation, you told that for companies, it's always 3CA. That's not the case. Sometimes companies also go to 3CB. Sorry for deviating. Now coming back, when we chartered accountants are supposed to certify the financial statements of non-corporate entities, we are bound by the guidance notes. In case if we don't follow the guidance notes, we are supposed to give the reason and justification for not following it. That being the case, it's very, very important, friends, that in case if we are not able to give all the disclosures that have been given in the guidance notes, what we have to do? We have to very nicely qualify under part 3 of the 3CD report. So considering this guidance note being compulsory from this year, I urge and I request all of you students here, understand that, have study circles in your offices and start implementing it in your offices so that you will do a real value addition to your bosses, and you are all young minds. You can learn and understand this. People in their 50s, 60s who have been doing the work in a particular way. Even today we come across balance sheets and financial statements that are directly taken from Tally and members certify them. Going forward, if we do that, there is this Financial Reporting Review Board of the ICAI which may apprehend the member. So considering this, I would again like to thank the Mangalore branch for giving this opportunity to me, and I congratulate each of the presenters for wonderfully taking me through the topics. Thank you one and all.
As we strive for continuous improvement, feedback is a vital element in driving growth and reflection. Thank you, sir, for sharing your valuable insights on today's session. As we wrap up this intellectually stimulating session, I extend my immense gratitude to the Honorable Chairperson and the passionate paper presenters for their outstanding contributions. Your thought-provoking perspectives and depth of knowledge have truly elevated our understanding of the subject. We are grateful for the time, effort, and expertise you have generously shared with us today. I'd like to request CA Salome Lobo Pereira to present a small gesture of a heartfelt thanks to our dear Chairperson and the paper presenters. Attention delegates, we are pleased to inform that each student kit contains a lucky delegate coupon. Kindly take a moment to fill in your details on the coupon and drop it in the designated box placed outside the registration counter. I encourage everyone to participate. You might just be the lucky winner. I once again extend my genuine thanks to all the contributors for a highly enriching and detailed technical session.